gold, by the way, down 100. Said we're going to have one day when it's down 200. Maybe it's today. This is a ratio spread piece. It's fairly timely because this is an interesting type of spread here. We're going to go through it relatively quickly. We titled it Trade Smarter with Ratio Spreads. A lot of people like to do things like buy one, sell one, sell two, that kind of stuff. We don't like ratio spreads that get you short too many units. The one thing we like about simple ratio spreads, like 1x2, is the high probability of profit, and that you only really have to deal with a single naked option. And to me, that's a manageable spread, unlike multiple contracts. They grow teeth, as you can see in the latest move in the market. So we like to use put and call ratio spreads to act on a long or short bias, while also having the potential to profit if the move were to continue to decrease or increase slightly. We're talking out of both sides of our mouth here because we're not sure if it's going to be a put or a call ratio spread. But you see Tony and I do lots of ratio spreads. We usually do put ratio spreads when we think the market's oversold. We do some call ratio spreads when we think the market's overbought. But in this market, we're more likely to do put ratio spreads. Buy one put and sell two further out of the money puts. They are high probability trades. We usually hold them for short periods of time because they tend to pay off quickly on the first up move, and then we just move on for the next trade. They're trades that they're confidence building trades, generally speaking. Let's go to the next slide. Ratio spreads are so named because they require us to buy some amount of options and sell more than that amount against the long options. So does it have to be 1x2? No. You can do 2x3. You could do 3x5. In some cases, like things that people have gotten in trouble with, 1x3 or 1x4. Got to be careful about that stuff. And if you
1x1x2, sure.
1x1x2, all that stuff. Just stay small.
Watch your units.
Let's go to the next slide. We do ratio spreads for credit so that we get paid if the underlying goes infinitely in our biased direction. The payoff is as follows with a max profit at the short strike. But what you're looking for with most credit spreads is just a profit. It is, I don't think in all the years I've been trading, I've ever max profited a ratio spread. If you're going to max profit a ratio spread, it's going to be more like a butterfly. You're going to max profit a butterfly. You're rarely going to max profit a ratio spread. So you're just going to, ratio spreads are trades that have a high probability of profit. You just want to put a win on the board, make some money, move on to the next trade. Let's go to the next slide. Traders can set up ratio spreads as a function of delta exposure or what strike they wish to be their max profit target. Let me tell you how I do it, which is a little different than what's on this screen here. What I like to do is, and they gave you two different choices here, but what I like to do if I was doing the put spread is I like to go to the expected move. And I don't know exactly how you set yours up, Tony, but what I do is I go
to the expected move too.
So Tony and I
actually depend.
Tony and I both go to the expected move. So let's say I was trading XYZ stock and the expected move, and XYZ was $50 and the expected move was $5. My long strike would be at the expected move, $5 away, 45, and my short strike would be wherever I could go to get a credit. Right?
Yep.
Let's go to the next slide. Since we do the spread for credit, our probability of profit tends to be very high, given the lack of upside, or if you're doing it on the call side, downside risk. So we do these trades, like I've said. We put our long strike at the expected move. We put our short strike wherever we can generate a credit for selling multiples of, and we do it on whichever direction we feel is at a price extreme. So we feel like if we're at a downside price extreme, we'll do a put ratio spread. If we're at upside price extreme, we'll do a call ratio spread. Next slide, Beth. So we use ratio spreads in order to act on long or short bias while granting ourselves some extra room to the opposing side. It's a little bit, it's a lower potential profit, but a higher probability of profit than most other directional trades. You give yourself a little cushion, which is what we like about them. It's a trade that generates positive decay. It's a trade that has a directional bias to it. It's a trade that lets you pretty much hold it for as long as you want to until you get profitable. It's a trade that generally sits in that 90%, 88 to 90% profit range when you are doing it at the expected move. And it's a trade that a lot of traders like to use, especially in high IVR. Ratio spreads are considered higher pop trades with no risk to one side and a max potential profit to the other side. Although, again, max potential profit in ratio spreads is very misleading because I can't speak for Tony, but I don't even know the last time I've maxed out a profit on those things.
We play. I mean, it's a fortunate gift if it were to happen that way. I play for the credit received, some sort of profit from the credit received, not the max profit of a ratio spread. A little misleading, as you said.
Yep,
true, but misleading because we're not playing for that. We want the stock to go in the total opposite direction.